Good afternoon, a warm welcome to you all. My name is Pierre Schlosser. I work for the Florence School of Banking and Finance, and it is my pleasure today to introduce and moderate this online seminar. I'm very glad to be today in the company of Rolf Strauch, who is Chief Economist and member of the Management Board of the ESM, the European Stability Mechanism. Welcome, Rolf. A warm welcome too to Marcello Messori, who is Professor of Economics at LUISS in Rome and Director of the LUISS School of European Political Economy. Great you could join us, Marcello. Many thanks to both of you for being with us today. Before introducing the topic of today's seminar, I'd like to tell you a bit more about our school, as we have a few activities coming up that could be of interest to you. As you will probably know, the Florence School of Banking and Finance is a program of the European University Institute, EUY in short, located in Florence, Italy. The EUY is a culturally diverse community of more than 900 scholars from over 60 countries. As a postgraduate public and international research and education institute, the EUY has been offering PhD programs in social sciences for more than 40 years, and more recently, is also providing executive education courses to practitioners. Besides some policy debate activities, our school, the Florence School of Banking and Finance, focuses precisely on executive education and is a place of debate, a place of learning and of exchange, a place where multiple generations meet to discuss and argue about cutting-edge topics of financial stability, risk management, as well as banking regulation, supervision, and resolution. All this for Europe's common good. It is in that spirit that we hosted our annual conference on institutions and the crisis last week. And let me seize this occasion to inform you that in a few months you will be able to freely access our ebook, which as every year captures the strategic contribution of our senior speakers. In terms of executive education, so far our school has trained more than 1,300 professionals. Our participants mostly work for central banks and banking supervisors, but we also welcome experts from academia and the private sector. We will be hosting 3 residential courses over the next weeks on bank regulation and accounting rules next week in Florence, on the measurement of volatility and risk in Barcelona in 3 weeks' time, and on credit and market risk management at the end of June in Florence. We'll be announcing our second half 2018 residential courses next week, so stay tuned. Here is, however, for those of you present today, a teaser. You'll see that we'll have a course on liquidity, on macroprudential policies, on forecasting methods in economics and finance, and on bank resolution. Okay, enough about us. Let us talk about you, the audience, probably eating your sandwich in front of your desk, as I know from some of you. You are around 110 participants connected today, following us from everywhere in Europe and the world. And let me add that I recognize a few familiar names, so let me say hello to Unur, André, Yanis, and Daniel, amongst others. 32 nationalities are represented. We have, as often, many people from several national central banks, as well as from the European Investment Bank, the ESM, not surprisingly, the ECB, the SRB, and the Commission. 42% of you are women, 58% are men. You have, on average, about 8 years of professional experience. And as is often the case, the majority of you are is made up of trained economists, but we also have lawyers and business and social science backgrounds with us today. Lastly, most of you have a master's degree, while 30% of you have a PhD. Right, so the topic of today's seminar is the road to a European Monetary Fund. In this context, today's seminar will engage with the achievements and limitations of economic policy coordination in a common currency union, and will explore functional ways to deepen Europe's economic and monetary union, Europe's EMU. Given the state of European politics at the moment, for some reason I suppose, however, that we will speak more today about the road than about the European Monetary Fund, but as someone very smart once said, der Weg ist das Ziel, i.e. the journey is the destination, and it is indeed difficult to disagree with that. So with those words of wisdom in mind, let me now tell you more about how we will structure this seminar. Rolf will provide his analysis and views on the road to an EMF for about 20 minutes. Marcello will then react and offer his comments, and then Rolf will, however, have a chance to reply if he wishes to. In a third step, as is standard, as you know, we will open up the Q&A session where you guys will step in this context. However, I'd like to remind our speakers to stick to their speaking time. So let me stop here, leave the floor to Rolf, and in a second step to Marcello. So Rolf, can I ask you to please connect your camera and microphone, and in a second step to share them with the platform.
Hello, good afternoon, Pierre. Good afternoon to everyone on this online seminar. It's a great pleasure to talk to you today and to present to you our thoughts on the road to a European Monetary Fund. Now, in my presentation, I will first look shortly back at the origin of the ESM and why it was created, but then devote most of my time forward-looking to the current policy debate and to the discussion around the further development of the ESM towards a European Monetary Fund. To start with, it's important to remember that the European crisis was the result of two shocks. The first one was the global financial crisis that swapped over from across the Atlantic to Europe and created problems in the financial sector. The second shock was the sovereign debt crisis that emerged in Europe after 2010. And this was more homegrown. It was the result of the creation of the monetary union on the one hand and policies in member states that had not fully adjusted to that new reality. And as a result of that, there were a number of imbalances that emerged with regard to the fiscal situation, deficits and debt, but also with a view to competitiveness, and there were real estate bubbles emerging. Now, what happened then is that what basically was meant to be an unthinkable indeed occurred, and that was that Euro area countries, as advanced economies, lost access to financial markets. And as a consequence of that, the breakup of the Euro area became a real threat. Now, policymakers reacted to this with a broad set of measures. And for us at the ESM, it's very important to understand and to take that the ESM has not to be seen in isolation, but is part of a set of measures to address the crisis framework, to address the crisis. Now, I have listed those here on the slide that you can see. And you can see that there were first policy measures or measures related to economic policies, both at the national and at the Euro area level. At the national level, countries had to engage in budget consolidation and structural reforms to improve competitiveness. That happened more broadly across the Euro area, but certainly also in the countries that had a program with the ESM. The other component of that is at the Euro area level, because there was an initiative to take closer economic policy coordination in the currency union. Now, before the crisis, economic policy coordination was mostly ex post and focusing on the fiscal area. But with the crisis, three things changed. First one, it was also addressing ex ante economic policies, so that is done in the European semester. Second point is that it was broadened in scope from the fiscal area towards macroeconomic imbalances more broadly, and we have now macroeconomic imbalance procedure. And the third element is that the position of the European Commission was strengthened in this area in order to enforce the framework. Certainly a very important component of the crisis reaction was the monetary policy and the use of non-standard measures that last until today and was crucial for overcoming the consequences of the crisis. Now, the last two measures mentioned here, in my view, are critical. They're also critical for the deepening of EMU because they essentially present a quantum leap in terms of European integration. And if you look back, what was achieved there is, in terms of size, actually bigger than what we are discussing now as further steps. And that is good to keep in mind because it tells us that the euro area is able to take such steps. Now, the first of it or is the strengthening of the banking system. It started with a common rule book and initiatives to make the banks safer, and this is effectively what happened. Capital ratios in banks are now much higher than they were before the crisis, and the regulatory framework has changed substantially. The second element is the creation of a single supervisory mechanism and a single resolution mechanism, which effectively moves those institutional levels up from the national to the European sphere. And that is essential in order to create a common European banking market. Now, the final element is the creation of the EFSF and the ESM, so the European Financial Stability Facility and the European Stability Mechanism as crisis resolution mechanisms. Let me go here more into detail on that part. Now, here it is the EFSF and the ESM jointly have a lending capacity of 700 billion. Of that, 500 billion are with the ESM, only a small portion of which is used. We have still a lending capacity of around 400 billion. Since 2011, we have provided roughly 280 billion in loans to member states. That is about 2.5 times as much as the IMF has provided worldwide. That money was lent to 5 countries, to Ireland, Portugal, Cyprus, Spain and Greece in different programs. Most of the countries have exited the programs in the meantime and have done so successfully, and I think it can be claimed that those are success cases because current growth rates are above those of the euro area, and those countries in that respect are really catching up and recovering from the crisis. The remaining country that has still an active program going is Greece. The program is meant to end in August, and we very much expect this to be the case. So also in Greece, we can see that substantive progress has been made, and if the further process of the program is followed and afterwards kept, we are very forward-looking that this also will be a success case. Now, how is the ESM operating? So the ESM is a lender of last resort for those countries that have lost market access. In order to support countries, it has the highest paid-in capital of all international financial institutions. This is 80 billion of paid-in capital. On the funding side, we differ very much from the IMF because the IMF is funded by central banks, while we have to get our financing on the markets that we will then on-lend to countries that receive financial assistance. Our funding and lending to the countries does not imply any direct cost for taxpayers. We are not on-lending our capital, but it stays with us in order to secure our creditworthiness. Obviously, it's also true that the member states face the risk of exposure, but there is effectively no direct budgetary cost. In terms of our lending, we very much apply the same system as the IMF in demanding strict conditionality and policy reforms from countries in when they get financial assistance, and actually that has to be proven to be the case that those measures are implemented before disbursements are made. Those measures serve to cure the underlying weaknesses that are found in the country and structural imbalances. In turn, where we differ from the IMF is that our terms of lending are relatively more favorable in 2 respects. The costs are fairly low. We pass on our funding costs, but we don't charge high margins. The second element where it differs is that we can lend at very long maturities. In the case of Greece, the maturity is up to 32.5 years on average, so very long. And in combination, it means that a country like Greece at this stage gets loans for 32.5 years at an interest rate of 1%. Now, to go a bit more again into detail how it worked, here first the element of structural reform and conditionality. What you can see on this chart is that the program countries or former program countries were effectively among the reform champions within the euro area and even beyond when you compare it to OECD countries. And as a result of this, the Lisbon Council that provided the data also for this chart concludes that the reforms done in the country programs may have overall led to a more balanced and potentially more dynamic euro area economy. The second point is related to the lending conditions. And as I said before, our terms of lending are rather favorable. As a result of that, we create real fiscal space for the countries receiving financial support. On this chart here at the table, you see the financial impact of our financing compared to what countries would pay in the market. And the numbers here are very big. In the case of Greece, it means that Greece annually saves about 10 billion euro through EFSF, ESM financing as compared to market financing. That is a fiscal space of 5.6% of GDP every year. So an important contribution to the sustainability of public finances and the growth of the country. Now let me turn back to the bigger picture and briefly reflect where we stand now and how we will be going forward. Now, what have we achieved so far with a view to the crisis and resolving the crisis? And here first I think it's worth highlighting the good news. The first point to note is that per capita growth is again back to the long-term pre-crisis levels, and it is in line with US per capita growth. Actually, it's even slightly higher. The second point, which is very important, is the fact that growth in Europe has been more inclusive than elsewhere. And there are two components to this. The first one is that growth has led to more employment, and that is reflected in growing participation rates, and it's also reflected in recovering of employment rates. So that overall, today, there are more people on the job in the euro area than there were at the start of the euro area and even before the crisis. The second element of inclusiveness is that the euro area has a more equal income distribution as basically any other region on the world. And this is important to note also because the euro area in turn is even more open than many other major economies of the world. So there is no contradiction between openness and income inequality. And that's a big achievement, and it's also important for the political economy that we see around the globe. As a consequence of the recovery, we also note that the attitude of euro area citizens has changed. Now, 3 out of 4 euro area citizens support the euro. This is higher than before the crisis, and actually a very strong recovery of more than 10 percentage points since the crisis. And it provides a strong backing for also a political discussion about the deepening of EMU. Now, not everything is fine, obviously, and that there are a number of challenges out there on which we have to work. Some political, some economic. The most important one for discussing the deepening of EMU is the third one, which is making the European Monetary Union more robust. But let me briefly go through all of them. So on the political side, on the one hand, we came stronger out of last year and the elections that were held last year than many had anticipated, with anti-European forces gaining less scope. But still, obviously, the issue of populism remains. What also remains is the threat of protectionism, political questions around migration and security. Those have to be addressed forward-looking. A pertinent issue is obviously Brexit, and here just to repeat what Mr. Barnier said last week at a conference, Brexit is a loss-loss situation for Europe, but obviously also clear to note that the loss will be more for the UK than it will be for the euro area. The second element is the area of growth, where there is the challenge of raising potential growth, also in view of aging and in view of future potential development. And here's a number of areas in which Europe can act there that relates to investment, to education, and to the scaling of innovation, but this also extends to national policies. Now, turning to the third area, making monetary union more robust. We have to note that there are still some legacies of the crisis. One is that euro area public debt levels are still higher than during the pre-crisis area, but they are slightly declining, so they have stabilized and are even reduced. The second point is that while the banking system has indeed become much safer, and that I explained before, there are non-performing loans outstanding and at elevated levels in some countries. Those have to be addressed. At the same time, profitability in the banking system is still lower as compared to the US, and for many investors, therefore, European banks or euro area banks are meant to be less lucrative as investment. The third point is that there is lower financial market integration than prior to the crisis, and I will show that in a minute. And that matches in the final state, with the final point, which is the institutional change that needs to be complemented and fine-tuned. Now, on the financial integration, what this slide here shows are two indicators that the ECB provides on financial integration based on quantities of financial instruments and on prices. And according to both indicators, it shows that currently the financial integration of the euro area is less than prior to the crisis. Why does that matter? It matters with a view to the risk sharing in the euro area. Now here you see a chart based on different studies that compares the euro area with other major economies, federal countries. And what you see first is that asymmetric shocks, so that are kind of economic developments that do not affect the entire economy but work differently for different regions, are kind of buffered and smoothened much more in other major federal economies as compared to the euro area. So in Canada, the US, and Germany, according to those studies, 80% of those asymmetric shocks are covered and smoothened out. This only is about 40% for the EU and the euro area. The second point to note here in this chart is that the majority of that effect comes from capital markets. The second component are credit markets. Both can be explained or seen as private sector risk sharing. That is complemented then through fiscal policies or fiscal transfers, so public sector risk sharing. So what emerges from this picture is that private sector risk sharing is a very important component, and the more you do on private sector risk sharing, the less you need to do on public sector risk sharing. And that is good to note and to understand the initiatives that are currently discussed for the euro area in EMU deepening. Now we go to that topic. So, as I've just explained, one of the key components for EMU deepening and for making the euro area more robust for future crises has to do with private sector risk sharing. And here the first element is the completion of banking union. The second element, the completion of capital market union. The completion of banking union has been termed by President Tusk as one of the key priorities to work on for the Eurogroup in order to prepare the upcoming summit, Euro Summit of political leaders in June this year. There are two key elements to this agenda. One is the creation of a common backstop for the Single Resolution Fund, and the second element is the European Deposit Insurance Scheme. The creation of the European Deposit Insurance Scheme, however, will only be possible after legacy issues are sufficiently addressed and resolved and banks have undergone some further de-risking. Completion of Capital Market Union entails a number of different initiatives. Here are two important elements mentioned, which is the strengthening of European supervision and second, the harmonization of insolvency and tax legislation. Tax legislation should also do less to favor debt compared to equity and therefore remove the debt bias. Now we come to the ESM and the move towards a European Monetary Fund. Let me first say here, the name of European Monetary Fund per se does not matter too much. What we are mainly concerned about is the substance of what the institution can and will do in the future. Now here there are different elements of that debate. First, on that there is quite a consensus among policymakers is that the ESM could be the common backstop to the single resolution fund. That is discussed by Euro area ministers. The second element is that the crisis resolution role of the ESM could be broadened in the sense that in the future the ESM jointly with the colleagues from the European Commission would design and monitor future adjustment programs and also look into policy conditionality. In order to be able to do that, the ESM would need to be in a position to be in contact with member states on a regular basis, also outside a crisis situation, and then be able to quickly design, jointly with the Commission colleagues, a program. This is not the case so far, but at this stage the ESM mainly engages in monitoring after a program in order to assess the repayment capacity. The third element here is that the ESM could take a role in managing debt sustainability in a crisis resolution framework and how debt issues can be addressed if a country faces them and there may be an unsustainable debt level. The final point on debt, there is however less agreement, and then on the first point and the broader crisis adjustment role, which is the provision of a macroeconomic stabilization facility, which could take the form of shorter-term loans that do not extend over the very long run as our current crisis resolution loans. And that could help in order to prevent actually a crisis situation emerging and provide good financing to a country when it's hit by a negative shock. Now, there is a final area that I quickly want to address, which is, again, much less consensual than the completion of banking union and a crisis resolution role for the broader crisis resolution role for the ESM / European Monetary Fund, and that relates to the fiscal sphere. Here, on the one hand, what is contemplated and proposed in some documents, including the 5 Presidents' report, is a simplification of fiscal rules to make them more credible. Fiscal rules have changed over the crisis in order to adjust to the situation, but at the same time, this leads to the fact that it can be less well understood, and when they cannot be easily understood, that undermines effectiveness. So there is a need to again look at them. The second element, and there are very many proposals and ideas out in that field, is fiscal capacity for macro stabilization. One option, and that I mentioned before, is a shorter-term facility of ESM loans. Other possibilities that are discussed are rainy day funds or a complementary unemployment insurance scheme. Again, there is at this stage no consensus at all in this area. The final element on the fiscal front is the creation of a common budget in order to find public goods. And here one has to think about defense, a limited defense budget, or say a limited budget for border control in order to preserve those public goods. I think this overview helps you to to understand a bit more where the current discussion is going and how to look at the ESM and the possibly evolving role of the ESM and the further deepening of monetary union in order to make it more robust.
Thank you very much, Rolf. Marcello is connecting from Rome. Thank you. And the presentation is loading. So, Marcello, over to you.
Good afternoon. I'm very glad to have this opportunity to comment Rolf's presentation, which raised a number of quite stimulating points. Obviously, it will be possible for me to address all these points. Hence, let me focus on 4 aspects, 2 more general and maybe 1 or 2 are more specific. The 2 general aspects refer to the deepening of the European Economic and Monetary Union and the strengthening of the European Stability Mechanism, and relate to EDIS and the so-called sovereign debt restructuring framework. Then, if I had some more time, I would like to address some further points and particularly to refer to the lack of resharing in the euro area. Let me start by analyzing EDIS, that is the European Deposit Insurance Scheme. Rolf's thesis is that EDIS implementation requires the bank's solution of a number of legacy issues as well as banks de-risking. However, as far as I understood, Rolf doesn't specify the organization of EDIS. As you probably know very well, there are several definitions of the working of the European Deposit Insurance Scheme. In some cases, the European Deposit Insurance Scheme has to play just a role of last resort. In other cases, EDIS would have to ensure full risk-sharing for depositors below 100,000 euro. Moreover, there is a problem of sequencing, that is, how to manage the implementation of EDIS and in the meantime solve the legacy issues and the risks involved in the bank's balance sheet. My view is that we would have to refer to full EDIS and we would have to work quite deeply on specifying the transition process. It's well known that a number of European banking sectors have to reduce the amount of their non-performing loans. Moreover, we discovered in the first cases in which the single resolution scheme operated that there are a large number of national idiosyncratic regimes in the second pillar of the banking union. Moreover, we know very well that a number of European banking sectors have too large exposures in their national sovereign bonds. However, it seems to me that we would have to discuss the balance between these processes of risk reduction and the implementation of EDIS. Let me just offer to you an example by referring to the reduction in large exposures. In my view, in order to offer a right incentive to national banking sectors in the reduction of large exposures, we would have to introduce a safe asset in the European financial market. You know very well that safe asset is a necessary condition in order to improve the efficiency in the working of financial markets. Moreover, in this specific case, a safe asset could offer a buffer to banks' potential losses in the reduction of their large exposures. Moreover, a safe asset would play a crucial role in the stabilization of sovereign debt in the euro area peripheral countries. It seems to me that Rolf underassessed just a bit this problem. We know that there are several proposals for the introduction of safe assets in the European financial market. In my view, the most famous proposition, that is the introduction of EDIS, is not the right solution due to the fact that EDIS do not represent safe assets. Hence, in my view, it would be necessary to have the involvement of the European Stability Mechanism for the issues of safe asset represented, for instance, by a bundle of national sovereign bonds into specific EDIS. Let's now turn to my second general aspect, that is the reference to the so-called sovereign debt restructuring framework. According to Rolf's thesis, it would be necessary to create a predictable private sector involvement. In my view, this implies that the sovereign debt restructuring must be an ex-ante mechanism. And in my view, if we introduce a quasi-automatic ex-ante sovereign debt restructuring, this would lead to a quasi-automatic private sector involvement in all the member states which have to enter into a European aid program. And this involvement of the private sector would imply an increase in macroeconomic instability as well as an increase in the redenomination risk. We have a good example for that. Before the events in 2011, we had the agreement in Deauville between the President of France and the German Prime Minister. And it seems to me that the Deauville scheme offers a good example of a tool for instability in the European financial and real markets. Obviously, if we criticize ex-ante sovereign debt restructuring, we need to offer alternative possible solution, and in my view, it would be necessary to build up ex-ante binding commitment and to introduce possible sovereign debt restructuring in the case in which these commitments, these ex-ante commitments are not met, are not ex post met. It would be possible to elaborate on this point, but I guess that my time is more or less over. Hence, let me conclude my comment by referring to a specific issue in Rolf's presentation, that is the need to promote risk-sharing in the euro area due to the fact that we have a lack of risk-sharing. And the suggestion offered by Rolf is to improve risk sharing by completing the banking union and strengthening the role played by the European Stability Mechanism. Hence, implicitly, the thesis is that the European Economic and Monetary Union does not need a centralized fiscal capacity, and in perspective, the euro area does not need a gradual construction of a fiscal union. However, if we refer to the figure in slide 10 offered in the presentation, it seems to me that there is evidence of an opposite story. The main reason why in the euro area we have a lack of risk sharing is due to the poor performance offered by fiscal policy. Credit market is a good performer in the risk sharing by means of market mechanisms. We lack an efficient coordination and efficient harmonization between fiscal policies. Thank you.
Thank you very much, Marcello. I'd like to ask Rolf to come back on screen. So by connecting mic and camera, so that then we can have his reactions. Of course, Marcello, you can also stay on stream. That's not a problem. Rolf, maybe 2 or 3 minutes of reaction, and then we open the floor for the Q&A, if that's okay.
Yes, thank you to do so, and thank you, Marcello, for the comments. I think on the first comment that relates to banking union, we are basically fully aligned with what you say. Is indeed the key point here is to have the right package of risk reduction and risk sharing through EDIS. And the current political discussion is precisely on this point: how much further risk reduction maybe is needed in order to move towards EDIS. And for EDIS, since you said that there are different proposals out there, that may be right, but here we also see as a basis for the discussion the proposal that has been put forward, or actually the 2 proposals that have been put forward at different stages by the European Commission, which very much operationalize the framework. So I think there is quite some common notion in that regard. On the second point that you mentioned on debt restructuring, I apologize then for not maybe being sufficiently clear. From our perspective, we should not engage in any kind of automatism in this area. What is indeed necessary is to look at it at a case-by-case basis and assess debt sustainability. When we ask for more clarity, then it just means that what we have experienced in the past is that when we enter into a situation of problems with debt sustainability, the process wasn't fully clear. So more clarity could mean that we have more clarity on the process to decide, once we find that that is not sustainable, to decide what to do. That is the main element of more clarity. The second issue is whether one could strengthen the capability of addressing sustainability issues by changing the contractual rules in order to prevent holdouts from disturbing any solution. And here one issue that is discussed is the question of whether one might change the so-called collective action clauses. But again, to be very clear, we do not want to advocate any automatism in debt restructuring. That could indeed be pro-cyclical and very counterproductive. On the last point that you mentioned, also again, I apologize if I wasn't clear enough, but here we agree that some fiscal capacity is needed. If you look at the figures and the chart that I presented, indeed you see that the main channel that is missing or is much smaller in the euro area as compared to the other federations is the capital market. And again, the euro area is no federation per se, and we also think that, at least for the foreseeable future, we will not move towards a full fiscal union. That is politically not palatable at this stage, and as we see it, also not for the foreseeable future. Now, nonetheless, fiscal capacity is necessary. It's also necessary because during financial crisis, actually, that financial market channel may dry up, and then you need support on the fiscal side. So this is fully in line also with what we think about a system, a robust system of risk sharing. Thank you.
Okay. Thank you very much. We'll now open the floor for question and answers. And before jumping into your numerous questions, what we'll do is that we're going to put down the results of the different polls that we've run during the Q&A. So here it goes, the first question and the second question results. I'll just ask Rolf to come back on stream so that then we can have a lively Q&A exchange. So the first question was about the backstop to the SRF, which is not very much a surprise, but maybe Rolf, you can, or you would like to comment this one. So respondents said to 85% yes and to 15% no about the question whether the ESM should provide a backstop to the SRF. Surprising? Is that encouraging? Is that...
No, I mean, I think this basically...
Does it mean that 15% still need to be convinced about this?
In my view, this indeed reflects to some extent what is also visible at the political level among policymakers, where I said there is rather broad spread consensus that the ESM could take that role. And I think here it's basically a matter also of pragmatism and availability of financial resources that people see why the ESM could take up that role. So from that perspective, what one sees here reflected or confirmed what is also apparent elsewhere.
Okay. Then the second and the third question is a bit more tricky. As we can see, the level of consensus is actually decreasing, and I'll give also a chance after giving you the floor to Marcello to also comment. So it was about the debt restructuring framework, and 67% were saying that indeed the ESM could manage this to make it more robust, and 33% were disagreeing. So first Rolf, maybe, and then Marcello.
Well, I don't know whether this kind of poll was taken, so to speak, or the question had to be answered before I made my second intervention, because I hope my second intervention actually clarified how we think about it. Let me just add one point. At this stage, part of the ESM treaty is already the provision that in case that is not sustainable, one would have to envisage debt restructuring. That is why in the case of Greece, there was first actually the history biggest debt restructuring before we could enter that program, the second Greek program. So from that perspective, what I just said in that context is no fundamental change. The only point that basically we are suggesting is, again, to have more clarity in the process in case there is a need, but no fundamental adjustment of the framework per se.
Okay. Marcello?
Thank you. It seems to me that the last statement made by Rolf is quite clarifying, and on this basis it's possible to reach a good agreement. I try to emphasize that it's not necessary to introduce an ex-ante restructuring mechanism due to the fact that ex post ESM has full capability, according to the current regulation, to state if a member state is able to recover its lost access to the financial market in order to finance its sovereign debt, or it's in a permanent insolvent position. Hence, it's difficult to me to understand why it's necessary to introduce a more binding ex-ante rule. This is only a signal to the market in order to increase instability. Hence, in my view, it's not necessary to change the current regulation. And from this point of view, there is another problem raised by the third question. If we allow ESM to play this larger role, this improved role ex ante, we would have a conflict area between the current duties of the European Commission and the new duties of the European Stability Mechanism. Hence, for this reason too, it seems to me that it's not convenient to change the current. If
I may directly react to this, indeed, and I'm very happy that that point comes up, because our intention is not at all the desire to change the current regulation. And very clearly there is a role enshrined in the treaty and also set in secondary legislation that assigns the role of surveillance to the European Commission, and that per se is a given. We cannot change that, and we don't want to change that. What I said before, however, what is necessary from our perspective is that for us to be able to be an efficient crisis resolution mechanism that in a broader role of doing and designing programs jointly with the European Commission, when asked to do so and do so rapidly, we must have an opportunity to be in contact with member states also in quiet times and in order to gain some insights. That is, I think, a precondition for effectively filling that role, but there is no intention on our side to go into surveillance that under the European fiscal framework is assigned to the European Commission. We think our role can be filled in a complementary way, and it can work from under that limited scope.
Okay, thank you. We've seen that some participants are typing, which is a good sign, so we'll wait a bit for different questions. The first question was from David, actually from Luxembourg too. So about precisely what you were saying, the risk for conflicting mandates or conflicting recommendations. I think to some extent this has been covered, so unless you would like to go again into this, I would move immediately to Nicolas' question. On the cutoff from markets, do you mean that crisis countries did not receive any credit at all, or only at costs which were politically unacceptable? Rolf, the question is...
It's a very fair point and very valid point, because what we observe in the crisis is only partly quantitative cut-off, so that actually the amounts that could be raised were too small, even though that happened as well. But often it is discrimination, price discrimination, it's simply that it becomes too expensive. And here for me it's not only a matter of political feeling about it, but it's also indeed a matter of sustainability in financing. And when rates become too high, and they became with the redenomination risk up to 15 percentage points, then it's indeed certainly unsustainable. What we experience for the crisis, that indeed the area of 7% seemed to be some kind of a benchmark where countries felt that cannot be managed anymore in terms of overall sustainability relationship. So that means, and when prices become, when it becomes too expensive in terms of interest rates to issue, then there is a point where countries may contemplate of moving to the ESM. That may not entail all the markets, because we also have to see that in many cases countries continue to be able to issue bills but not long-term bonds. And we have also to see that our instruments are very flexible in this respect. in a sense that for the case of Spain, Spain maintained market access, and we addressed mainly the problem in the banking sector, which was a rather targeted intervention, but the country was not entirely off the market. To the contrary, Spain kept market access, and we took care of the additional portion to reassure markets that was necessary for the banks.
Okay, thank you. There is a question that will also appeal, I'm sure, to Marcello. So a question by Gisela on the idea of the role of ESM as the lender of last resort versus central banks as lender of last resort.
In my view, there is a fundamental difference in the sense that according to the European treaties, central bank cannot play the role of lender of last resort towards European member states, or better saying, the member states of the euro area. In the case in which these member states are temporarily losing their access to the financial markets and need to enter into a European aid program, then the central bank cannot play any role, and it's necessary to have recourse to a different institution. And from this point of view, I fully share the idea that ESM has to become, in a very complete meaning, in a very complete perspective, the risk manager of the euro area. Let me add that the problem is the early intervention. We can learn a lot of hints from the problems open in the second pillar of the banking union, that is in the resolution, in the single resolution mechanism and in the resolution process. Obviously, before a bank becomes very close to a failure and requires the intervention of the single resolution board, we can have early intervention. And in this case, early intervention is a role played by the central bank, or better saying, by the single supervisory mechanism. The same applies, in my view, in the managing of European crisis for sovereign debt. In this case, in my view, early intervention can be played by European Commission, and ESM can have and can be appointed for a full intervention in terms of ex-post risk management. In this perspective too, it seems to me inappropriate to have an ex-ante sovereign debt.
So as we're running out of time slowly, I'll give the floor again to Rolf to answer that question, and then we'll take one or two last questions. Please, Rolf, the floor is yours.
Thank you. I mean, I would fully agree with Marcello on the fundamental point that in monetary union, the central bank per se cannot be the lender of last resort. That is what changed actually with the creation of the ESM. And even though it's not my point to talk here about the policies of the ECB per se, but that's also my way of looking at the OMT. One should not forget that the OMT is linked to having a program, at least a credit line, where there are reforms requested with the ESM, otherwise the ECB cannot decide to engage. And there, again, also from an ECB perspective, it's mainly to preserve the functioning of monetary union and the functioning of the monetary transmission mechanism. and it's up to the ESM to back up the country per se.
Okay, thank you very much for clarifying this. There is a last question at this stage that we have on risk reduction, where Vanya is asking whether there are any risk reduction targets under discussion at the moment, be it an amount of NPLs that would be acceptable for reaching an agreement on EDIS, because clearly, apparently, the two issues are connected, but you will tell us more.
I mean, first of all, in the current discussion, there is already quite an amount, a strong recognition that there's already quite a significant amount of risk reduction that was achieved, and also a reduction of non-performing loans. I mean, since the peak, the amount of non-performing loans has been cut by 1/3. So that is very clear that it is in the discussion and receives recognition and is a basis for at all engaging further in that process. Now, here the question is indeed what else is necessary, and that relates to the point of does one want to define some quantitative benchmarks or not in order to measure risk reduction? Does one want to have more qualitative benchmarks for defining more risk reduction? And what comes to mind here is also the point of policy initiatives. For example, the question of whether one wants to have more harmonized insolvency laws, which we now find out through practical experience that they're actually very important for the bank resolution process and what can be done in different countries. So I think this is not a discussion that is set, but that is part of the overall debate in order to achieve a good package and to move forward.
Okay. Let me give the floor to Marcello and ask for closing remarks.
Thank you very much. Well, referring to non-performing loans, I largely agree with Rolf's position. It seems to me that it would be convenient to distinguish between a legacy problem and the new flows. In terms of legacy problem, it seems to me that it's necessary to define a process of reduction, a gradual process of reduction, and from my point of view, the new suggestions offered by regulator and supervisor are quite efficient, and it seems to me that it's possible to handle these type of process for more or less all the European banking sectors. In terms of flows, obviously we would have to discuss further the introduction of a qualitative or quantitative threshold, and I think that it would be convenient to have a qualitative.
Thank you, Marcello. Rolf, I don't know if you had any closing remarks.
Well, just one closing remark. So for us, when thinking about deepening EMU and about a European Monetary Fund, it's not predominantly about the ESM per se. It's not predominantly about the name of a European Monetary Fund or ESM. What it is predominantly about is what we want to achieve in terms of robustness for the euro area. And we think about that from our perspective. Indeed, there are areas where the ESM could efficiently fill that role and add to the robustness, and that is in the points that I mentioned before as a common backstop in developing programs jointly with Commission colleagues, and if agreeable, in the area of fiscal stabilization. That is how I look at it. Okay.
Thank you very much. Let me apologize to Lorenzo and Michael for not being able to answer their questions today. This seminar is reaching its end. I hope you enjoyed it as much as we did here. I'd like to warmly thank our speakers for their time and dedication, and for all of you actually for your questions. Our next online seminar will be in 3 weeks' time on the 22nd of May at 1 p.m. Our speakers will be Jean Dermin from INSEAD and Giacomo Calzolari from Bologna University, and they will deal with bank lending in the age of digital disruption. So mark your diary and see you very soon.